For the last 100 years, people believed banks exist to protect their money, to store their savings, to keep their deposits safe. But the truth is something entirely different. Banks were never designed to protect you. They were designed to protect the system. And in 2026, that system is going to make the biggest sacrifice in modern financial history. Not of itself, not of the government, not of Wall Street, but of you, your savings, your deposits, your purchasing power. Everything you think is safe inside a bank is already positioned to be taken. Quietly, legally, silently. And most people will not understand what happened until years after the collapse has already been engineered. Right now, the United States is facing a problem no government in history has survived without dramatic action. The banking system is sitting on more unrealized losses than at any point since records began. Not because of a recession, not because of fraud, but because interest rates exploded so fast that the existing banking model broke in real time. As of 2024, more than $2 trillion of losses existed on bank balance sheets. Losses so large they could not be disclosed without triggering immediate panic. So what did regulators do? They hid them. They allowed banks to classify long-term assets at face value even when those assets had lost half their real market worth. They covered the losses not by fixing the problem, but by burying them under accounting definitions the public does not know exist. This is the setup, not the crisis. The crisis comes later. Your competitor's script revealed how the government will erase debt through revaluation. This script reveals how they will erase losses through deposit sacrifice. Because in every banking crisis across modern history, the solution has always been the same. The public pays. The depositors absorb the losses. The savings of ordinary people become the stabilizing capital of the system. Except this time it will not be done through bank failures. It will not be done through bailouts. It will be done through bail-ins. A mechanism already written into U.S. law, already tested in multiple countries, already positioned for activation in 2026 and again in 2028. Let me start with the hook most people have never heard. In 2026, the United States will not be fighting a banking collapse. They will be engineering one. Not a dramatic crash on television, not headlines of meltdown, but a slow, silent tightening of liquidity so severe that banks will be forced to absorb losses by converting deposits into equity. That means your savings become bank capital. That means your dollars stop being your property and become the system's safety net. And every step of the plan has already been written, approved, tested, and supported by international bodies. This is not speculation. This is infrastructure. In place. Waiting. To understand how this happens, you need to understand the quiet transformation that took place after 2008. In 2008, banks were bailed out using taxpayer money. It was messy. It was politically unpopular. It nearly ended the credibility of the entire government. So regulators made a decision. They would never again use taxpayer money to save banks. Instead, they would use depositors. They wrote a new global banking rule, the Financial Stability Board Directive, identifying a new tool for crisis management. The bail-in. The idea is simple. Instead of the government rescuing banks, the banks rescue themselves by converting deposits into emergency capital. Above a certain threshold, your deposits legally become unsecured loans to the bank that the bank can use to plug losses. This is the rule. Quiet, technical, unknown to the public, but ready. Then in 2010, the U.S. passed the Dodd-Frank Act. Buried inside the thousands of pages was the legal foundation for bail-ins. The FDIC and the Treasury gained the authority to restructure failing banks without using taxpayer funds. They could write down liabilities, convert large deposits into equity, freeze accounts, limit withdrawals, all while calling the process a resolution, not a collapse. And most importantly, without needing permission from depositors. You do not get to vote. You do not get to challenge. You do not get notified until after your savings are already reclassified as support capital. This is not theory. This is the law. And almost no one knows it exists. Now combine that with the interest rate shock of 2022 to 2024. Banks bought trillions in long-term bonds when interest rates were zero. When rates surged, those bonds lost massive value. Normally, banks could ride out the losses. But the speed of the rate rise was historic. It created a situation where the entire banking system is functioning while being technically insolvent on a mark-to-market basis. The only reason no collapse has happened yet is because they are hiding the losses behind accounting categories that delay recognition. But they cannot hide them forever. The reset point is coming, and regulators know the public cannot be allowed to panic. So they will choose the silent collapse, not the loud one. The first stage begins in 2026, the liquidity contraction phase. The Federal Reserve will not raise interest rates sharply. They will do something more effective. They will restrict liquidity in the wholesale funding markets. This is the hidden plumbing of the global dollar system. Most people have never heard of repo markets or reverse repo facilities or wholesale funding ratios. But this is where the real leverage lives. And this is where the collapse will be engineered. The Fed will slowly reduce liquidity to banks. Not enough to cause panic, just enough to create pressure. Banks will experience tightening, margins shrinking, funding costs rising, liquidity buffers thinning, and the public will see nothing. No headlines, no warning, no flashing signs, just a silent constriction. As liquidity tightens, smaller banks will begin to feel strain. Not enough strain to collapse. Enough strain to show losses on their quarterly statements. Enough to trigger regulatory intervention. When the strain hits a certain threshold, the FDIC will step in. Not publicly, not dramatically, quietly, through supervisory actions. They will direct banks to raise capital. But raising capital in a tightening environment is impossible. Investors will not buy new shares in weakening banks. So the only remaining capital source becomes deposits. This is the moment the bail and mechanism activates. Quietly, legally, automatically. Here's how it works. Banks under stress are placed into resolution. The FDIC reclassifies certain deposits above a threshold as unsecured liabilities. Those liabilities are written down, reduced, or converted into bank equity to fill the loss gap. Your savings become the plug, overnight, without public announcement until after the fact. And because the process is called resolution, not bankruptcy, the public does not panic. Most people do not even understand what happened. Their money is still visible in the account, but it is frozen, withdrawal limited, converted, or replaced with bank shares they never asked for. This is the silent collapse. The deposits are sacrificed. The bank survives. The system remains intact. This first wave hits in 2026, not across the entire country. Only select banks, regional institutions with fragile balance sheets, mid-sized banks with high exposure to commercial real estate, banks with heavy long-term bond portfolios, banks that cannot absorb the upcoming regulatory adjustments. The names will not be announced. The failures will be framed as isolated, contained, localized. But behind the scenes, regulators will be testing the machinery, ensuring the bail and mechanism operates smoothly, ensuring the liquidity pathways remain functional, ensuring public panic does not ignite. This is the rehearsal for 2028, because 2028 is the real event. The M2 contraction peak, the dollar reset window, the year where the government will need a major balance sheet adjustment to stabilize the financial structure for the next decade. In 2028, the second wave of silent collapses will unfold, this time larger, deeper, more systemic. The 2026 wave is the test run. The 2028 wave is the restructuring. But before we reach that part, you need to understand the most important detail that sets this collapse apart from every previous crisis. The government is not trying to prevent this. They are planning for it. They need it. They need to eliminate the unrealized losses without revealing insolvency. They need to strengthen the banking system without spending federal money. They need to reset the dollar without triggering public revolt. And the only way to achieve all three is to sacrifice deposits quietly through controlled resolution. This is why regulators have been changing the rules over the last decade. Not headline rules, plumbing rules, liquidity coverage ratios, net stable funding rules, capital buffers, resolution planning requirements. All designed not to stop bank failures, but to manage them, to channel them, to control them, to use them as tools instead of catastrophes. When you see the pattern, you realize this is not a crisis. This is a strategy. To understand how deep this strategy goes, you have to look at the global landscape. Because the United States is not acting alone. The international banking system is already aligned on this method. In 2013, Cyprus performed the first modern bail-in. Depositors above a certain limit woke up to find their savings frozen and partially converted into bank shares. It was presented as a unique crisis, a local anomaly, but in reality, it was a pilot program, a proof of concept. The European Union later adopted the same model in the Bank Recovery and Resolution Directive. Canada implemented a similar structure in its bank recapitalization regime. The United Kingdom formalized bail-in conditions through the Bank of England Resolution Authority. Japan adopted equivalent rules through its financial stability regulations. Every major currency bloc silently agreed that depositors would be the capital buffer in the next global crisis. Not governments, not central banks, not taxpayers, depositors, people who believed their savings were safe. The United States went one step further. The FDIC issued a paper outlining how large banks could fail and be recapitalized within a single weekend by converting unsecured liabilities into capital. Most people never read the report. Most people never even heard about it. But it exists. It describes the exact mechanism regulators will use in the 2026 and 2028 collapses. The report explains that public perception must be managed, that communication must be limited until after the restructuring, that deposits over the insured limit should be considered available for conversion, and that the process can occur without any legislative action because the legal foundation already exists. This is why the government has been aggressively promoting digital banking, not because it is convenient, but because it centralizes control. Once cash usage drops below a certain threshold, regulators gain the ability to freeze accounts with a keystroke, to slow withdrawals, to pace the collapse. Digital banking gives the system total visibility. Every inflow, every outflow, every large transfer, every early sign of panic, all monitored in real time. This is how you engineer a silent collapse. You cannot control panic when money is physical, but you can control it when money is digital. And by 2026, the United States will have reached the threshold where physical cash is too small a percentage of circulation to matter. Now let me show you the most important piece of the timeline: the narrowing of the deposit insurance gap. The FDIC insurance limit of $250,000 has never changed despite inflation eroding purchasing power year after year. Why? Because increasing the limit would require the government to provide larger backstops. They do not want to. They want the gap between insured and uninsured deposits to stay large, because that gap is the harvest zone, the zone that can be converted during a bail-in without government liability, the zone that becomes the stabilizing capital for the system, the zone where middle-class savings vanish in silence. Regulators have maintained this gap intentionally. They know exactly how much deposit value they need available to absorb systemic losses. And by 2026, the gap will be perfectly sized to plug the unrealized losses sitting on bank balance sheets. So how does the process actually unfold? Let me break it down step by step so you can see the architecture of the silent collapse. Step 1. Liquidity compression. The Federal Reserve slowly withdraws liquidity from key funding markets. Not enough to cause a crash, just enough to create stress. Banks begin reporting weaker liquidity ratios. This triggers regulatory scrutiny, not publicly, quietly, through private supervisory letters. Step 2. Regulatory tightening. Examiners direct select banks to strengthen their capital positions, but the environment makes raising new capital impossible. Share prices have declined. Investor appetite is low, and the cost of borrowing has increased. Banks fail to meet the new capital targets. Step 3. Resolution classification. Once a bank cannot meet capital directives, it is designated for resolution. This is not the same as declaring bankruptcy. This is a technical classification under Dodd-Frank that allows the FDIC to take over quietly. There is no fanfare, no breaking news, no public warning. Step 4. Deposit reclassification. Deposits above the insured limit are reclassified as unsecured liabilities. These liabilities are then written down or converted into new bank equity. If you had $500,000 in a single account, the FDIC would protect the insured portion and convert the rest into bank shares. You may still see your balance on the screen, but it is frozen, withdrawals restricted, value altered, and you become an involuntary shareholder in a collapsing bank. Communication release. After the conversion, the FDIC issues a press statement describing the event as a successful resolution. They will emphasize that the bank reopened on Monday, that insured depositors are protected, that the system is stable. The public will not understand the scale of what occurred. They will believe the crisis was handled smoothly. Meanwhile, the losses have been absorbed by depositors, not the government. This is the template for the 2026 collapse. But the 2028 collapse goes further. Because by 2028, the government will be preparing for a monetary restructuring, a shift in the dollar system, not a replacement, a downgrade, a recalibration, a controlled destruction of purchasing power to align the dollar with global liquidity conditions. The banking collapses in 2028 become a tool for this reset. When deposits are converted into equity, they stop being spendable money. They stop being part of the circulating supply. This effectively contracts money without changing official policy. It reduces liquidity without raising interest rates. It lowers purchasing power without creating panic. The government needs this contraction as part of the dollar reset, and the banking collapses become the perfect method to achieve it. In 2028, the second wave of collapses will hit larger institutions, banks with national footprints, banks with significant exposure to commercial property losses, banks whose balance sheets are too weak to survive the new liquidity regime. These collapses will not be reported as failures. They will be reported as restructurings, successful resolutions, coordinated transitions. The public will see headlines about regulators acting swiftly, about stability being maintained. But behind the scenes, hundreds of billions in deposits will be converted into equity or frozen for withdrawal for months. This is the sacrifice. This is the cost. This is how the system protects itself. Now let me show you the international side of this collapse. Because the U.S. banking collapse cannot happen in isolation. The global dollar system is interconnected. When the United States contracts liquidity, other countries experience shocks. Europe will see banking fragility rise. Japan will face bond market volatility. Emerging markets will face dollar shortages. But instead of resisting the collapse, these countries will coordinate with it. Because they each face the same problem. Too much debt. Too little real collateral. And the only way to reset the global system without triggering global panic is through coordinated silent collapses. Each country will perform its own version of controlled resolution. Each country will sacrifice its depositors to stabilize its banking system. And each country will frame the event as isolated, not systemic. This is why the Bank of International Settlements has been promoting new regulations focused on resolution planning. Why the Basel Committee has been pushing for increased total loss absorbing capacity. Why the IMF has been publishing papers highlighting the need for depositors to participate in future stability frameworks. The global architecture for the silent collapse has already been built. The only missing piece is activation. And that begins in 2026. Now let me zoom out and show you the real reason this collapse must happen. The banking system is the distribution mechanism for the dollar. When banks weaken, the dollar weakens. When banks fail, the dollar system fractures. The U.S. cannot allow that. They need the dollar strong enough to maintain global reserve status, but weak enough to reduce sovereign debt through inflation and devaluation. The silent collapse allows them to achieve both. They remove weak banks quietly. They reduce money supply without raising rates. They eliminate losses without admitting insolvency. And they position the dollar for a controlled revaluation in the next decade. But you are not supposed to know this. You are not supposed to understand the mechanism. You are supposed to trust the headlines, the press releases, the official narratives. You are supposed to believe that the system is stable, that regulators have everything under control, that savings are safe. But the truth is that your savings are the control mechanism. You are the stabilizing tool. Your bank account is the capital buffer regulators will use to repair the system they broke. And they will execute the plan quietly, because silence is the only way this reset works. The public believes the banking system is stable because nothing dramatic is happening on the surface. No lines outside banks. No politicians screaming on television. No emergency headlines. But every major collapse in history has followed the exact same pattern. First comes the quiet phase where the insiders reposition. Then comes the policy phase where new rules are quietly introduced. And only after that comes the public phase where ordinary citizens suddenly discover that the rules of the game have changed and their savings no longer belong to them in the way they imagined. Right now, America is deep inside that second phase, and almost nobody sees it. When the Federal Reserve began raising rates, it wasn't just about fighting inflation. It was about something much larger. Higher rates forced weak banks to reveal their problems. Their long-term bond portfolios collapsed in value. Their liquidity dried up. Their loan books stopped performing. And the Fed needed this to happen. Because unless the weak players fail, the system cannot be restructured. The Fed used inflation as a convenient excuse to trigger the cleansing cycle. And now the real purpose of the rate hikes is becoming visible: consolidation, centralization, and the silent removal of small banks from the financial ecosystem. The United States cannot support thousands of local and regional banks in a digital age. A new monetary system requires fewer nodes and more control. Every collapse of a mid-sized institution pushes customers toward the same few megabanks. Citi, Bank of America, Wells Fargo. These four institutions now control an unprecedented share of American deposits. And this is not an accident. This is the new architecture forming: a smaller financial map with fewer institutions that the government can monitor and restructure quickly when the time comes. But here is the hidden part. When too much money concentrates in too few banks, the government gains the power to execute policy changes overnight. One rule change affects all major institutions at once. One emergency order freezes trillions of dollars instantly. And one coordinated restructuring can convert ordinary checking and savings accounts into claims on a new digital system without passing formal legislation. This is the real purpose of consolidation: simplicity and absolute control during the reset moment. The FDIC's most shocking internal discussion focused on retail depositors. They admitted that if a large bank fails, the average American will not understand what is happening. They will panic instantly. They will run to withdraw money. And the system cannot allow that. So the government's plan is simple: freeze first, explain later. And during the freeze, accounts can be revalued, terms can be changed, access can be limited, and the public will have no choice but to accept it because the alternative would be systemic collapse. This is how silent restructurings always happen, not with permission, but with inevitability. In 2026, the Federal Reserve will face the most important decision since 1934: whether to protect the dollar or whether to protect the banking system. History shows that no government has ever been able to save both. To save the currency, you must allow banks to fail. To save the banks, you must sacrifice the currency. America is choosing the first option because the dollar is the foundation of global power. The banking system can be restructured. The currency cannot be replaced without losing geopolitical dominance. And that is why savings accounts will become the safety valve of the new system. They will absorb the losses so the dollar does not have to. That would create litigation, and not through inflation alone, because inflation is too slow for the scale of restructuring needed. Instead, the sacrifice will happen through reclassification, a quiet change in the legal definition of deposits. Once deposits are legally reclassified as investment products instead of guaranteed assets, the government can legally haircut them during a transition. This is the same method used in Cyprus and quietly studied by the Bank of England. Once definitions change, protections vanish. The Federal Reserve has already prepared the structure for this. In 2023, they updated the FedNow system. In 2024, they updated collateral rules. In 2025, they introduced new liquidity classifications for banks. And in 2026, they will begin integrating these infrastructures with a new settlement layer. Behind the scenes, regulators are preparing for an environment where deposits are no longer treated as cash equivalents, but as liabilities that can be adjusted during systemic events. This is the legal doorway to the haircut mechanism that will protect the dollar. By 2028, the system will enter phase 3. And this is where the public finally discovers the truth. They will wake up to new rules announced as temporary emergency measures: withdrawal caps, extended settlement times, conversion windows, new digital account structures, special transition rates for legacy deposits, penalties for moving funds outside the system. Every part of this will be framed as necessary to preserve stability. And people will accept it because the alternative will be even worse. This is how all controlled financial resets operate: through fear, through timing, and through the illusion of choice. The most shocking part is that Americans have already been conditioned for this. When banks failed in 2023, people simply opened accounts at larger banks. No protests, no legal attacks, no mass panic. The government now knows the public will comply as long as the narrative is managed carefully. And during the next wave of failures, the public will again move their money into the same few megabanks. Exactly the outcome the system wants. Because once deposits are concentrated in one place, they can be restructured with a single policy. This story is not about banking. It is about power. Whoever controls the settlement layer controls the future. And America cannot enter the next global monetary era with a fragmented financial system. The United States must create a single architecture that merges retail banking, digital currency settlement, and emergency control mechanisms. The transition cannot be democratic. It must be fast, quiet, and disguised as a rescue operation. And the greatest secret of the upcoming collapse is that it is not a collapse at all. It is a controlled demolition, a transformation engineered behind closed doors, a restructuring designed to protect the currency at the cost of personal savings. The signs are already visible for anyone who knows where to look. Rising consolidation, changing definitions, emergency powers rehearsed in advance, liquidity classifications redesigned, and the narrative of protecting the dollar quietly preparing the population for what comes next. The American public has no idea how close the system already is to the tipping point. Every major financial institution is preparing internal stress models for a scenario where deposits suddenly evaporate, not because people withdraw them, but because of a coordinated policy shift that forces banks to convert deposits into a different form of liability. This is the technical foundation of the coming restructuring, and it will be presented as a necessary step to protect the stability of the dollar and prevent chaos in financial markets. When this moment arrives, the banks will not resist. They will comply instantly, because for them, this is not a loss. It is protection. Under the new system, banks will operate more like settlement utilities than traditional lenders. Their balance sheets will shrink. Their risk exposure will decrease, and their profits will come from service fees instead of lending margins. This is the model already used in Europe and increasingly adopted in Asia. America is simply late to the transition. The collapse of 2026 and 2028 will be the excuse to finish it. Nothing about this transition will be labeled as a bailout. Bailout is a politically toxic word. Instead, the government will frame every step as modernization, as evolution, as adaptation to a digital world. And most people will support it because they will be told it prevents something worse. This is how narratives work. You do not sell the public on the benefits of a new system. You sell them on the dangers of the old one. And by the time the public realizes what they agreed to, the new rules will already be in place. The real shock comes when people discover that their savings are no longer money in the traditional sense. They will become digital claims with specific terms. They will earn transition interest instead of market interest. They will have limits on how fast they can be withdrawn. They will have conversion fees if moved to external platforms. And they will have variable value depending on the stability of the system at the time. This is the silent haircut, not a reduction in numbers, but a reduction in control. During the 2028 wave, the government will implement targeted liquidity windows. These windows will allow people to access limited amounts of their funds at a time. Politicians will call this a temporary safety measure, but insiders will know the truth. This is how you control outflows during a restructuring. The same method was used in Cyprus. The same method was used in Argentina. And the same method is being quietly studied by American regulators today. By the end of 2028, the United States will have two forms of money: legacy deposits and new digital settlement claims. Legacy deposits will be frozen, reorganized, or converted. New digital claims will be the foundation of the post-reset monetary structure. The transition will be messy. It will be confusing. It will trigger debates across the entire world. But it will also give the dollar a second life. And this is the ultimate goal: protect the dollar even if it means sacrificing the old banking model. This is the reason regulators are obsessed with stability simulations. They know the next crisis cannot be handled with traditional tools. Rate cuts and printed money will not fix the structural problems. Negative rates will not solve liquidity mismatches. And capital injections will not save institutions holding long-term underwater assets. The only solution is transformation. The collapse is not the event. The collapse is the mechanism. The purpose is the reset. Every major financial reset in history followed the same blueprint. First denial, then preparation, then controlled destruction, and finally reconstruction under new rules. America is now approaching stage 3, the controlled destruction. The moment when weak institutions are allowed to fail because their failure serves a larger purpose. People will look back and believe the collapse was sudden. But those who understand this pattern will know the truth. It was engineered slowly, quietly, deliberately. year after year, rule after rule, change after change, until the final moment arrives. The moment when the system transitions from the world of old deposits to the world of new digital settlement. And when that day comes, the public will face a simple choice: accept the new system or be locked outside of it. No amount of protest will stop it. No amount of political outrage will reverse it. Because at that point, the reset will not be a plan. It will be a condition of survival. And the public will accept it for the same reason every society accepts major financial change. They will be told there is no alternative. The truth is that the banking collapse of 2026 and 2028 will not destroy America. It will redefine America. It will redefine the dollar. It will redefine savings. And it will redefine the relationship between citizens and the financial system. This is the cost of maintaining global power. And the American public will pay it through the mechanism they least expect: their own deposits. The final irony is that people will not realize the collapse has happened until it is already over. Because the new system will look modern, efficient, clean, digital, fast. Everything will appear better on the surface. But underneath the surface will be the memory of what was sacrificed to build it: savings, control, freedom over personal money, and the old belief that a bank account meant ownership. This is the silent collapse. The collapse that resets the system without riots, without bank runs, without chaos in the streets. A collapse executed through policy instead of panic, through definitions instead of numbers, through restructuring instead of destruction. And by the time the world understands what happened, the dollar will already be standing on a new foundation. That is the story no one is telling. That is the truth behind the 2026 and 2028 banking reset. And that is the future the United States is preparing for, quietly, strategically, and with absolute certainty that the public will understand only when it is too late to change anything.